Hey guys, Ken Boyd with the Accounting Accidentally website. This is an explanation of a statement of cash flows, both the direct method and the indirect method. Remember, you can go to the website Accounting and Accidentally to find over 350 blog posts and links to over 350 to 400 YouTube videos, accountingaccidentally.com. So what I created for a client was 2019 and 2020 balance sheet and income statement. So this is the balance sheet for each of 2 years, and this is the income statement for each of 2 years. Now, what's important here is that to compute statement of cash flows, you need to calculate the changes between a lot of these balance sheet categories. This is why I have this up here. I also have a spreadsheet. So the easiest way to do statement of cash flows is to put the before and after, if you will, in this case 2019, 2020, next to each other and calculate the differences as you'll see in a minute. So, how do I get to cash flow from financing? Financing is defined as raising money, cash inflows from issuing stock or issuing debt and paying it back. And it also includes dividends. So using the spreadsheet that we saw back here in the balance sheet, we had a cash flow from financing debit increase, and we had a dividend payment. Debit increase, a debt increase, excuse me, and a dividend payment. So let's think about that. If you have a debt increase, you're getting cash flow in. If you pay back debt, you're paying money out. So in this case, we're paying money out 5. So the cash flow is -5 because we're paying back debt. If we pay a dividend, that's also cash flow going out the door. That is a -18. So our cash flow from financing is -23. How about investing? This is about buying and selling assets. So PPE, property, plant, and equipment. In this case, we have an increase and we have brackets around it. We have a decrease, it's a positive number. Same thing of other fixed asset. If we have an increase, we subtract it. Decrease, positive number. So if we're buying PPE, that's money going out the door. It's a 72 decrease. If we have an increase in fixed assets, that's money going out the door. We have a -7, so the cash flow from investing is a -79 going out the door. Cash flow from operations is the most difficult, and this is a section of the old sheet. You'll see 02, 03 at the top. It should be 19 and 20, but it still makes the same point with the same data. So this is the indirect method. And the indirect method means that we start with net income and then we reconcile down to the change in cash flow from operations. So we start with net income, we go down to cash flow from operations at the bottom. And here's the hard part. Current asset increases are subtracted, decreases are added. With current liabilities, it's the reverse. Current liability increases are added, decreases are subtracted. So if I flip all the way back to this balance sheet and you look at the increases and the decreases in these balance sheet accounts, both current assets and current liabilities, and I scroll back down to here, these differences are based on changes in the balance sheet. So for example, we have an increase in accounts receivable of $64, that is subtracted. We have an increase in other current liabilities, it's subtracted. On the other hand, an increase in a liability account like accounts payable is added. So you add all this up and you get cash flow from operations 57. So the sum of the financing -23, the investing -79, and the cash flow from operations 57, if you add all that up, that is the net change in cash. And the ending balance in cash should agree, if I go up to the top again, to the ending balance in cash for 2020. So the sum of those three numbers equals cash in the balance sheet at the end of the current year, 58. So financing, raising money and paying it back. Investing, buying and selling assets. Operations is Day-to-day operations, running your business, making a product or service, paying payroll, billing clients, and collecting money. So the key takeaways are most cash flow activity is from operations, as I just mentioned. Investing means cash inflows from buying and selling assets. Financing refers to raising money from issuing stock or debt and paying it back. Remember, you can join Conference Room. You see the address here at the top of the page where you'll see a live chat, blogs, videos, and it's an accounting community where you can get more in-depth information on accounting. Thanks very much, and we'll see you next time.